Accounting concepts refers to the necessary assumptions and ideas which are fundamental to accounting practice. Each and every organization is treated as a separate unit or entity quite distinct from the owners who own it. It is therefore necessary that such statement should be prepared according to some standard language and set rules. Hello everyone, I am Harshita, lecturer, Department of Commerce, Vidhyaashram First Grade College, the Temple of Excellence, Mysuru. My dear students, today I am going to discuss the fifth session of your first unit, that is Introduction to Financial Accounting, and this is under the subject Fundamentals of Business Accounting for first time BBA students of Mysuru University. Now, in your previous session, we have discussed few of the important concepts based on this Introduction to Financial Accounting. So, let us quickly move on to the session, and the topics what I am going to discuss today is very important from the examination point of view. Okay, so let us see what is this theory base of accounting. So as I've already told you, it's not just that accounting is not just that you have to record the business transaction as per your own wish. So there are certain theoretical aspects where we have to learn that and then we have to solve the problems. In the sense, before knowing the theoretical aspect, we can't directly move on to solving the problems because we have to know what type of transactions we have to record, what we can't record in the books of account, when to record, how to record. All these theoretical aspects are included in the accounting. So, accounting is called as science. So, accounting is both science as well as art because accounting contains theoretical aspect also, and after learning the theoretical aspect, we are going to apply. So, it is called as an art. So, now let us see what is this theory base of accounting. So, what is actually the theoretical aspects of accounting? Okay, so theory base of accounting consists of principles. So, I have told you there are certain principles, rules, regulations to be followed. Overall, it is confined as what? Theory base of accounting. So, theory base of accounting consists of accounting principles, accounting concepts, accounting conventions, rules and guidelines developed over a period of time. So, now why we have to follow all these rules, regulations, guidelines, as well as principles, concepts, conventions. So, why we have to follow that? So, without which what happens? So, there will not be uniformity in the books of accounts. So, when you want to compare the accounting results from one organization to another organization or from one accounting period to another accounting period, then you have to maintain a systematic as well as uniform rules and regulations. Then only you can compare the accounting results. So, the main intention of following all these rules, regulations, concepts, guidelines, conventions, it's because only in order to bring the uniformity as well as consistency. So, in order to bring the uniformity, so if there is no uniformity in the books of accounts, then you can't compare the accounting results. If you compare also, your accounting results will not be proper. It goes wrong. So, in order to bring the uniformity and consistency in the process of accounting, in order to enhance the utility of various users of accounting information. So, the main intention, so suppose if you are comparing your business organization in the market, so what happens? So, if you are not following the accounting principles, then you can't compare that because whatever the accounting results which is been ascertained as per your wish, so it can't be compared with that of another. So, if all the organization follow a proper as well as systematic as well as a single rules and regulation, then of course there will be uniformity in the books of account so that you can compare the accounting results. So, the main intention is to bring uniformity and consistency in the books of accounts. In addition, accounting standards issued by the Institute of Chartered Accountant of India, that is ICAI, also constitute the theory base of accounting. So, along with the rules, principles, concepts, conventions, so we have certain accounting standards also. So, there are a number of accountants and other institutions who have come together and they have framed a proper as well as systematic as well as single accounting conventions. That is, overall we can tell that So they are all come together and they have maintained or they have developed a theory base of accounting which has to be followed by every organization so that your comparison can be easy. At the same time, you can maintain a proper uniformity in the books of accounts. Now, so under theory base of accounting, let us see what is the meaning of accounting principles. Okay, so accounting statement disclose the profitability and solvency of the business to various parties. Of course, in your previous session, we have learned that the main intention of maintaining books of accounts or accounting. So, that is in order to know the financial position of the business as well as profitability of the business. At the same time, what is the solvency of the business? Solvency condition of the business. Okay. So, it is therefore necessary that such statement should be prepared according to some standard language and set rules. So, I have already told you, when you are maintaining a proper books of accounts, then systematically you have to follow certain rules and regulations. So, you have to follow certain standard rules and regulations. Then only your accounting information will be in that standard. Or else if you are following on your own wish, then that information can be used by you only. So, you can't compare or you can't communicate to the users. These rules are usually called generally accepted accounting principles. So, we can shortly call it as GAAP. So, what is this GAAP? So, as the expansion itself tells, generally accepted accounting principle, which means that generally it is accepted by everybody all over the world. So, if you are maintaining one particular rules and regulation which is accepted by everybody, then your accounting results will also be prepared in a systematic manner. At the same time, your comparison as well as what is your standard, what is the standard of your organization in the market. So that also can be ascertained. These principles have been generally accepted by accountants all over the world as general guidelines for preparing the accounting statement. So, these are the general guidelines. It tells us how we have to maintain a proper books of account. So, what are the transactions we have to take, when to take, so how the adjustment has to be made for a particular transaction. All these will be given by this accounting principles. These principles have developed over a course of period from usage, reason, common experience, historical, statements of individuals, professional bodies and regulations of government agencies. It was not an easy task to maintain a proper standard of accounting principles. So, it is the effort of accountants and other accounting institutions who have struggled a lot, where they have experimented those accounting principles and they have come to a proper conclusion. So, everybody have come together and they have come to a proper conclusion to maintain a proper standard in the to maintain that standard in the books of account by following certain rules and regulations. Now, let us see about GAAP. So, what is this GAAP? Generally accepted accounting principle. As I have told you, these are the principle which is generally accepted all over the world. So, generally accepted accounting principles refers to the rules or guidelines adopted for recording and reporting of business transaction. So, when we are going to follow this rules and regulations while maintaining the books of accounts. The purpose is to bring uniformity. So, as I have already told you, now you might be having a question, why we have to follow all these rules and regulations? Yes, of course, in order to maintain the uniformity in the preparation and presentation of financial information. Let every organization follow certain standard principles. Okay, so that you can get uniformity in the financial statements. So, that would be the main intention of GAAP. Now, let us see what are the kinds of accounting principles. So, we have accounting concepts or assumptions, and the second one is accounting conventions. Now, this would be the very important topic. So, you might get a question for 15 marks or for 10 marks, or you might expect for 5 marks also. So, go through this accounting concepts in detail so that you can get marks. So, and this is important not only from the examination point of view. So, before recording the transaction, you have to know this basic principles before recording the transactions. Okay, so your accounting principles are accounting concepts or assumptions, and we have accounting conventions. Now, let us, in this particular session, we shall discuss about all the accounting concepts. Now, what is this accounting concepts? Accounting concepts refers to the necessary assumptions and ideas which are fundamental to accounting practice. So what you have to remember when you hear the word accounting concepts, so these are the assumptions as well as ideas which are fundamental to accounting. So while maintaining the books of accounts, so these are the assumptions as well as ideas you have to follow while recording in the books of accounts. That is known as what? Accounting concepts. Now let us see the accounting concepts. What are the accounting concepts we have? So the first one is business entity concept. So we are going to discuss each and every concept in detail. Second one is money measurement concept. Third one is going concern concept. Fourth one, accounting period concept. Fifth one, cost concept. Sixth one, dual aspect concept, or it is also called as accounting equation concept. Revenue recognition concept or realization concept. And the next one is matching concept. And the ninth one is accrual concept. And the 10th one is objectivity concept. So these are the important accounting concepts. So let us discuss each and every concept in detail. Now coming to your first one, business entity concepts. So before going to the explanation, I'll tell you what is this business entity concept. So according to this concept, it tells us business and owner are not one and the same. Okay. So you being a owner, you and your business. So you and your business are not one and the same. They are two different entities. So they are not one and the same. They are two different entities. Being a owner, you can invest into the business which is called as what? Capital. When you invest, business will give you return. That is called as what? Interest on capital. Okay. And being a owner, you can withdraw from the business. So you can withdraw from the business, which is called as what? Drawings. So you can withdraw for your personal use called as drawings, and so for which you have to pay to the business, that is called as interest on drawings. Okay. Now, so business entity concept is too simple. It tells us business and owner are not one and the same. They are two different entities. Being a owner, you can invest into the business which is called as capital, wherein the business has to give some return for your capital which is called as interest on capital. In the same way, you being a owner, you can withdraw for your personal use whenever you are in need of money, which is called as drawings, for which you have to pay interest to the business called as interest on drawings. Clear? So it is not one and the same. Okay. So it means that in accounting, every business undertaking is regarded as a separate unit. So each and every organization is treated as a separate unit or entity, quite distinct from the owners who own it. So they are not one and the same. They are two different entities. In other words, the business and its owners are treated as two separate entities. So by this example, you would have understood, right? Business and owners are not one and the same. So if it is my business, I can't tell that whatever belongs to my business is mine. So me and my business are not one and the same. They are two different entities. Example, in proprietary concern, the business is different from its owner. The accounting records are maintained in the books of account from the point of view of business unit. So here also, when you are solving a problem also, you yourself have to think that you are the business, not that of a owner. So you yourself have to think that you are the business because you and your owner are two different entities. Therefore, when owner brings capital or makes drawings, they are entered in the books of accounts. So why do we record this capital and drawings in the books of accounts? Because they are separate. Owner and business are separate. Okay, so hope you have understood about this example. So this is your business entity concept. Second one is money measurement concept. So this you have already know. So while learning the definition itself of accounting, you have know what type of transactions you have to record in the books of account, only which is measured in terms of money. So it means that only those transactions which are expressed in terms of money, that is monetary transactions such as sale of goods for cash, payment of salary, etc. are to be recorded in the books of account. So, in a particular business, there are number of transactions that takes place, but we are not going to record each and every transaction in the books of accounts. For example, transaction means what? Activity or events that takes place in a business. For example, there may be purchase of goods, there may be sale of goods, payment of salary, receiving of interest. In the same way, an employee might resign from the organization. But can the transaction like employee's resignation can be recorded in the books of account? No, it cannot be measured in terms of money. So you can't record in the books of account. Even though it is very important and it affects the profitability of the business, but still we can't record in the books of account only for the reason that it is not measured in terms of money. So, only those transactions which is measured in terms of money or monetary units has to be recorded in the books of accounts. Transaction which cannot be expressed in monetary terms such as appointment of a manager. Now this is also important for the organization, correct? Appointment of a manager is also important. Retirement of an accountant, etc. are not recorded in the books of account. The only reason is what? It is not measured in terms of money. Thus, according to this concept, transactions are not recorded in physical units but in monetary units. Hope you are clear about money measurement concept. So, what you have to remember, there are number of transactions that takes place in a particular business organization, but you have to record only those transactions which is measured in terms of money. Other transactions you can't record even though it affects the profitability of the business, even though it is very important in the organization, but still you can't record in the books of account. Okay, so hope you are clear about the second concept. Third one is going concern concept. As the word itself tells us, going, which means that a business organization keeps on going. So, there is a particular sentence for this. People may come and go, but the business will continue for a longer period of time. So, there may be changes of the employees, there may be changes of president, there may be changes in the managers of a particular department. But when they leave, whether the business will stop? No. It will continue for a longer period of time. So, you being a businessman, you should have the intention that whenever you start a business, the business will prolong for a longer period of time, which means that it will continue for a longer period of time. Okay, so you will not invest crores together of amounts thinking that next year I have to close the business. So it is an utter loss, correct? So you are investing into the business on the thinking that the business will continue for a longer period of time. That is your going concern. So it means that in accounting, a business firm is regarded as a going concern. Going concern means what? It keeps on going. In other words, according to this concept, a business enterprise will continue to operate for a fairly long period of time. So I have told you, whenever you start a business, you should have that intention that the business will continue for a longer period of time. This concept provides the very basis for showing the value of assets in the balance sheet with proper calculation as fixed assets and current assets. So what do I mean by fixed asset? So you purchase an asset and you use that asset for a longer period of time. So that is your fixed asset, which means that you have purchased that asset keeping in view that the business will continue for a longer period of time. That is your going concern. So what does your going concern concept tells us? People may come and go, but the business will not stop. It will continue for a longer period of time. So whenever you being a businessman, you should start a business thinking that the business will continue for a longer period of time and it will not shut down in a very short period. So that is your going concern. Next is accounting period concept. So what is this accounting period concept? So you are going to take out transactions of a particular period, then you are preparing your financial statement, that is trading profit and loss account and balance sheet. So that duration is called as what? Accounting period, which means that you are going to take particular period's transaction and you are going to prepare the financial statement. So your accounting period may be for 3 months, that is on quarterly basis, or a half yearly basis for 6 months, or yearly basis. But usually we will follow yearly basis accounting period, which starts from 1st April to 31st March according to Companies Act 2013. Now it means that for measuring the financial results of a business, financial statements are prepared for the financial period or accounting period, which is normally a year. So when do we follow this accounting period? So that duration wherein you are going to take out the transaction and prepare the financial statement, that duration is called as accounting period. Example, calendar year. Suppose if you are following calendar year accounting period, then it starts from 1st April to 31st December. Sorry, 1st January to 31st December. Or if you are following the financial year, then it starts from 1st April to 31st March. So in our country, the Companies Act 2013 and the Income Tax Act require that the income statement should be prepared annually. So I have told you, your financial period can be on quarterly basis, half yearly basis or yearly basis. But in our country, as per Companies Act 2013 and Income Tax Act, we are following annual accounting period. So hope you are clear about accounting period concept. The fifth one is cost concept. Cost concept, or it is also called as historical cost concept. So cost concept means what? So when you are taking, so cost concept is merely into fixed assets. So when you purchase a fixed asset, so it's not only the purchase price of that particular asset is taken into consideration. So it includes purchase price or any other expenses until you are going to use that asset for the first time. So all that expenses are termed as what? Cost. For example, when you purchase an asset worth rupees 10 lakh. 10 lakh, and at the same time you have 5,000. So 5,000 transportation expenses, 5,000 installation expenses. So overall it is considered as cost. Clear? So it is not that only the purchase price of that particular asset is considered as cost. So it includes any other expenses until you are going to use that asset for the first time. Everything is termed as cost. Now let us see, cost concept means that an asset, that is fixed asset, acquired by the concern is recorded in the books of account at its cost or purchase price at the time of acquisition. The cost price includes, so let us see what are the cost price includes: cost of acquisition, transportation, installation and making the asset ready to use. Till then, whatever the cost which is involved, everything is termed as cost. In subsequent years, it should appear at its cost price less depreciation written off to date. Of course, when the value of that particular asset reduces, which is called as what? Depreciation. So that also should be considered while recording in the books of account. The market price of the asset should be ignored. So here we are going to take into consideration the cost price of the asset, not the market price. So hope you are clear about the cost concept. Next is dual aspect concept, or it is also called as accounting equation concept. So every business organization, dual means what? Two. So every business organization will have two effects. One is giving effect, other one is taking effect. So it is also called as accounting equation concept. So every business organization always results in receiving of some benefit and giving of some benefit simultaneously. So for example, when you purchase furniture for rupees 10,000, so furniture worth 10,000 comes into the business. At the same time, 10,000 cash goes out from the business. Correct? So one benefit comes in and one benefit goes out. Okay? So benefit of some value or giving of some other benefit of equal value. So there is give and take effect is always there in each and every transaction. Example, when a business concern sells rupees 1,000 worth goods for cash, it receives cash of rupees 1,000 and gives goods worth rupees 1,000. So in the same way, I have told you the example of furniture. Furniture comes in and cash goes out. Thus, every business transaction involves two aspects of equal value. So, each and every transaction, so it is called as double entry system. Each and every debit will have a corresponding credit also. Okay. So, this dual aspect concept tells us each and every transaction will have two effects, giving effect and taking effect of equal value. Dual aspect concept means every transaction has dual or two aspect and should be recorded in two places in the books of accounts. So this is, and it is also called as accounting equation. So let us see why it is called as an accounting equation. Dual aspect is a basic principle of accounting. It provides a basis for recording business transaction in the books of accounts. In fact, this concept forms the core of double entry system. So I have already told you about this double entry system, which tells us each and every debit will have a corresponding credit. Okay, so that is your double entry system. Now, the duality principle is commonly expressed in terms of accounting equation, which is as follows. Assets is equal to liability plus capital, which means that the total of asset should be equal to total of liability and capital. The same equation can be written in other way also. Liability is equal to assets minus capital and capital is equal to assets minus liability. So, this is your accounting equation. Okay, so what you have to remember under dual aspect concept, dual means two, which means that each and every transaction will have two effects. One is giving and taking of equal value. Okay, so it is also called as accounting equation concept, where the accounting equation is assets is equal to liability plus capital. Next, the seventh one is the revenue recognition concept or realization concept. So let us see what does this concept tells. The concept of revenue recognition requires that the revenue from a business transaction should be included in the accounting only when it is realized. So, which means that record the transaction in the books of account when it is actually taken place, not when you are going to actually receive or make payment for it. That is known as what? Revenue recognition, or it is also called as realization. And revenue is to be recognized or considered to be realized only when goods or services are transferred to the customer and customer becomes legally liable to pay for them. So, I have told you the transaction when it has been taken place, record that transaction on that particular date. Suppose if you are selling goods today, so record the transaction today itself, not when you are going to receive the payment for that goods. So, your payment might be after 2 days. But you are going to record the transaction when it is actually sold, not when you are going to actually receive the payment for that particular goods. When you sell, the other person will become the owner. So, record on that particular date, not when you are going to actually receive the payment. So, example, credit sales are treated as revenue or income on the day when sales are made, not when money is received from the buyer. So, hope you are clear about it. So, under revenue recognition concept tells us record the transaction in the books of account when it is incurred, not when you are going to actually receive the payment for it. Suppose if you purchase goods worth rupees 20,000 on credit. Suppose if you purchase goods today itself, so you will record the transaction today. But when you are going to make the payment after 1 week, don't record that date when you are making the payment. Record the transaction when you have actually purchased. So, that is your revenue recognition concept. Next is matching concept. So, in order to know the exact profit or loss of the business, we have to match your total expenses of the organization with that of total income. If the expense is more than income, then it is loss. If the income is more than expenses, then it is profit. So, what you are actually matching with? Income of your organization with that of expenses. If income is more, then it is profit. If the expense is more, then it is loss. It means that to measure the profit or loss of the business for an accounting period, all the expenses incurred should be matched with the revenue, which means that your expenses should be deducted from that of revenue earned during that accounting period. Thus, according to matching concept, all revenue earned during an accounting period, whether received during that year or not, and all costs incurred, whether paid during that year or not, should be taken into account while ascertaining the profit or loss for that particular period. So, you have to apply your revenue recognition concept also. So, you have to include the transaction when it is incurred, not when you are actually going to receive or make payment for it. Then you have to compare your total expenses with that of total income. If the income is more than expenses, then it is profit. If the expense is more than income, then it is loss. So, hope you are clear about matching concept. Next one is accrual concept. So, it means that revenue accrues in the year in which they are earned, not in the year in which they are actually received, or expenses accrue in the year in which they are incurred. So, if there is any expenses or income, so you have to record those transactions when it is incurred, not when you are actually receiving or making payment for it. So, you have to take into consideration in terms of year. Okay, so suppose if you have purchased goods in this particular year, record the transaction in this year, not in the year when you are actually going to receive the or make the payment for it. Okay, so that is about your accrual concept. Okay, so hope you are clear about it. Next is last concept, objectivity concept. So this you already know. So I being an accountant, I am going to maintain the books of a particular organization. So I can't record the transaction as per my wish. I have to follow certain rules and regulations. So whenever I record a single transaction, it may be of huge amount or small amount, I should have a proper documentary evidence called as voucher. Because I am working under some other organization, so I am responsible for each and every rupee here, and I have to be accountable to the organization. So whenever I record each and every transaction in the books of account, I should have a proper documentary evidence called as vouchers. Okay, so it means that all accounting entries should be based on objective evidence. Which means that whenever, so in my journal, suppose if I am going to record first transaction, so I can't record as per my wish, I should have a proper documentary evidence, which means that it can be receipts, it can be invoice, or it can be any cash memo, so anything, but it should have a documentary evidence which has to be serially numbered and preserved till the auditing takes place, till the end of the year. So, which means that according to this concept, nothing can be written as per my wish. I should have a proper documentary evidence. Then only I can record in the books of account. That is supported by verifiable documents such as vouchers, invoice, receipts, etc. The evidence must be objective, that is free from the bias of the accountants or others, and must be subject to verification by the auditors. So this I've already told you, whenever a single transaction, it may be of huge amount or it may be of small amount. So whenever I record a particular transaction, it should have a proper documentary evidence, without which I being an accountant, I can't record anything in my books of account. So this is about your objectivity concept. So hope you have learned what is a theory base of accounting. So you learned what is the meaning of theory base of accounting. Under that, we have learnt accounting principles. Under accounting principles, we have accounting concepts and accounting conventions. So what are accounting concepts? Accounting concepts are basic assumptions as well as ideas which are fundamentals to accounting. That is, while recording in the books of account, we have to follow these assumptions and ideas, and we have learnt all the 10 accounting concepts. So my dear students, hope you have understood this particular session. See you all in my next session with a new concept. Till then, take care. Thank you.